So you want to learn how to invest during a recession? In today's video, I break down 3 steps that you must know to invest during this recession. Stay tuned, mother people. What's going on? It's your boy, Kevin Yee from kickassinvesting.com. Before we start off today's video, I'm just kind of curious. What is your plan to invest during this recession? Leave a comment below, and also make sure to like, comment, subscribe so that the YouTube algorithm can pick up on this and spread this out to the masses. So it's pretty interesting. The other day, I actually got this flat tire while I was grabbing Indian food right before this whole COVID-19 thing was happening. So we get this tow truck guy, picks up my car. I'm in his truck with him, and we start talking about investing. It was really interesting. And he was telling me he's always wanted to invest, but now is not a great time to invest with the market at all. That was his words verbatim. And oftentimes I hear this quite a bit, where in times of panic, like what's going on right now, with the market taking a dive after a record breaking 10+ year run. And this happens a lot when the market isn't doing too well. A lot of people panic. A lot of people start thinking where it's like, oh man, I need to sell all my stocks. Let's turn them into bonds. And you have to realize we've been in this bull market for 10+ years. Something was going to happen. And unfortunately, something like COVID-19 happened to us and tanked our international market. But I will tell you this, the only way that you lose money if you were invested into the market at this time is if you sell. If you go to this strategy of selling all your stocks at this point in time after the market's dropped, you are locking in your losses. You gotta realize you don't lose any money unless you exit the market. You might think with this whole Corona thing that it's the downturn of the market and it's a bad time to invest. But really, just like I saw in 2019, a recession is the best time to invest, especially for young people like ourselves. Why is that? Let me give you an analogy that most of us Asian people went through. So back in the day, before we had a Costco around and all that, I remember whenever cereal or something like that went on sale, we would buy masses of it and store it up in our attic. Why was that? When prices were low, we would double down and stock up for months because we knew one day that the prices for that cereal would shoot up again. Take the same concept of cereal and whatnot and apply it to the stock market. This is the same reason why you absolutely need to invest, because you gotta look at it like this. We're not bleeding money. The stock market is on sale. It will eventually recover. So if you're in a good place financially, maybe you have a very stable job and you want to take advantage of this market, here's my 3-step process of how to invest into a market during times like these. Step number 1, simplify your investing strategy. So one of my friends, he's an investment banker. He day trades a lot. He has 4 different monitors all over the place and look at the stock market, right? Now, let's say if you walked in on this investment banker guy, you're a guy off the street, and somehow, he left his door open, and you go in and you're not trying to rob him. You're just trying to ask him, hey, what are you doing? And he's like, I'm trading, right? That would be such an overwhelming type of experience. Most people don't want to do that. They don't want to be spending most of their day looking at the market, seeing when it dips, trying to short the market and all that. This is true, especially when someone's just starting to invest. 95% of the people want a simple but effective method to shovel their money in and get 90% of the results without doing too much. I actually fall into this 95%, by the way. There's a lot of moving parts, especially when you're looking at individual stocks. You gotta look at PE ratios and all that sort of stuff, right? And so it just helps to simplify everything, to just shovel it into one thing that that will pay off in the long run. So my strategy is simple. Just focus on one thing to shovel your money into the market with one vehicle, not 10, but 1. My recommendation, S&P 500. We all know that in the long run, they outperform most mutual funds and all that sort of stuff, and most managed funds. And they're the best bang for your buck. Good old America, believing in America. There's nothing like believing in good old Uncle Sam. We all know that this country is run by companies, not its citizens. So that's one good thing about a capitalistic company. They will do their very best to prioritize our economy. Sadly enough, the two most common S&P 500 funds right now is Fidelity 500, FXAIX, and the Vanguard 500, VFINX as well. They also have their Admiralty fund. I actually break these funds down in a separate video, which you should watch over here. But you're probably asking, well, what do I invest in? Well, I actually shot a video on the difference between Fidelity and Vanguard funds. Make sure to check that out. Step number 2, you want to invest a set monthly amount every single month. So one of my personal friends, I used to work with him. He's like, hey, is right now a good time to buy the market? And the truth is, I don't know. No one really knows how the market is going to go. Yes, there are patterns and whatnot, especially there's a lot of day traders out there, but like I said, not everyone wants to do something like that. So what is the alternative? Dollar cost averaging. If this sounds like a foreign concept, imagine this. Dollar cost averaging is great because it's really hard to time the ups and time the downs of the market, and it's easy to get burned. Let's say we have this imaginary stock, it's $10 per share, right? And then we're like, man, maybe this is a really good price, so I'm gonna dump $1,000 into it. Next day it drops down to $1. Are you gonna have buyer's remorse? I bet you freaking will. But instead, if you set a monthly amount, it could be $200, it could be $500, it could be even $1,000 per month. When the market is high, you'll buy less of it, and when the market is low, you'll buy more of it. At the end, it kind of evens out and you'll get the best middle price as well. Over a long term, this is a better strategy than timing the market, because the truth is you can always be wrong. It's about systems, not just seeing what's hot right now. Sometimes people forget it's about long-term sustainable systems, not just like what's hot right now and what's not. But more importantly, dollar cost averaging is important because it actually has a psychological aspect where it simplifies the process. So you don't need to worry about how the market is doing. You just focus on the one task at hand, that's shoveling money into the market. Also, the great thing about dollar cost averaging, especially with mutual funds, you can't do this with ETFs, is automatic investing. You can put this on autopilot and set it, forget it. If you want to know how to do it, make sure to watch my video on how to invest for beginners with very little money. Shoot a video right here somewhere. Step number 3, if you want to double down in a recession, increase your monthly amount that you dollar cost average. So rather than throwing all your money in at once, like I said in the previous step, right? If you like I said in the previous example, if you throw your money all at once, you are really risking losing all your money in just the course of a day. Instead, you want to slowly infuse your money. Man, I feel like I'm in a pharmacy class, by the way. So for example, before this whole COVID-19 type of stuff, let's say you're investing $200 per day, but you really want to double down. Well, the best way to double down while we're in this recession is to increase that amount to $400 per month, where you're just investing into maybe a S&P 500. This is a really great way to kind of double down on the low prices, but not risk yourself to the point where you time the market incorrect. So if you want to know where you should open up your investment funds like a Roth IRA, make sure to check my video right over here. All right, so that's my 3 steps. Pretty simple stuff, guys. Again, let me recap. Step 1 is simplifying your investment strategy to just one vehicle. Second thing is invest a set amount every month. And the third thing is, if you want to double down during a recession, increase your monthly amount that you are dollar cost averaging. That is probably the easiest thing that any beginner can do. And it's really simple. Even your mom could do it. Now you're probably wondering, well, do I have any money leaks in my portfolio? Say no more, fam. I got a tool for you. I got your 12-point investing checklist where you can go step by step and see, am I missing this thing in my portfolio? You can find any leaks in your portfolio and plug them up. And also, the second thing I want to give you is my kick-ass investing masterclass. I'm actually in the middle of moving everything to a course place where you can actually track your progress. I'm trying to gamify it all the time, and it's completely free. It's a real free masterclass where I teach you how to invest into your Roth IRA in just over the weekend. So make sure to check it out. I think it'll be very helpful for you guys. And that is pretty much it. As always, make sure to like, comment, subscribe. And finally, did you agree with my strategy? What other things are you doing besides doing this. And by the way, did you agree with my strategy? Let me know in the comments. Otherwise, I will talk to you later. Take care of other people. Bye. And stay investing, kick-ass investors. Peace.